For centuries, financial bubbles have appeared again and again, destroying fortunes and shocking investors. Yet every time it happens, the people inside the bubble believe something different is happening. The strange part is this: bubbles are not created by irrational people. They are created by perfectly normal, intelligent humans making decisions that feel logical. To understand bubbles, we have to understand something uncomfortable. Markets are not driven by numbers. They are driven by human psychology. And human psychology has patterns. The same patterns that drive crowds at concerts, stadiums, and social media also drive financial markets. Every bubble in history follows a remarkably similar story. Economists call it the anatomy of a bubble. The story usually begins with something real: a new technology, a new opportunity, or a new financial innovation. In the 1600s, it was tulips in Holland. In the late 1990s, it was the internet. In 2008, it was housing prices. More recently, it was cryptocurrencies and meme stocks. The first stage of a bubble is called displacement. Something new changes the economic landscape. Early investors notice the opportunity. Prices begin to rise slowly. At this stage, everything still looks rational. After all, new technologies really do create value. But then, something psychological happens. More people begin to notice the rising prices. And rising prices attract attention. Attention attracts new buyers. This begins the second stage, the boom. More investors pile in, and prices start rising faster. Now early investors look like geniuses. Their success becomes a powerful advertisement. Friends tell friends about easy profits. News headlines amplify the excitement. This is where the most powerful psychological force enters the market: FOMO, the fear of missing out. Humans are social creatures. When we see everyone else getting rich, staying on the sidelines becomes emotionally painful. Investors stop asking, "Is this price reasonable?" They start asking, "How high can it go?" At this point, the bubble enters its most dangerous phase: euphoria. During euphoria, skepticism disappears. Every price increase feels like proof that the story is true. And something subtle happens to human reasoning. Success rewires our perception of risk. The longer prices rise, the more people believe the rise is permanent. History fades from memory. People begin to say things like, "This time is different." And that phrase, "this time is different," has appeared in almost every bubble in financial history. But bubbles don't pop because everyone suddenly becomes rational. They pop because the system runs out of new buyers. At extreme prices, almost everyone who wants to buy has already bought. The pool of new investors slowly dries up. This is where a strange idea takes over markets. It's called the greater fool theory. Investors no longer buy because something is valuable. They buy because they believe someone else will buy it for more later. For a while, this works. Prices continue rising, feeding the illusion. But bubbles are fragile systems. All it takes is one moment of doubt. Maybe interest rates rise, maybe a company misses earnings, or maybe nothing dramatic happens at all. Sometimes the bubble simply runs out of momentum. The moment prices stop rising, psychology flips. What once felt safe suddenly feels dangerous. Some investors quietly start selling. They take profits while optimism is still alive. This stage is called profit-taking, but the crowd barely notices. Then the decline accelerates. Prices fall faster than expected, and the same psychological force that drove the boom now works in reverse: herd behavior. Fear spreads faster than optimism ever did. Everyone rushes to exit at the same time. This final stage is panic. Prices collapse as buyers disappear. The strange thing is that the psychology never changes. The same cycle repeats across centuries. Tulip Mania, the dot-com bubble, the housing crisis, crypto booms and busts, different assets, different eras, but the same human psychology: hope, greed, envy, fear, which leads to an uncomfortable truth for investors. Bubbles are not anomalies. They are a feature of human markets. As long as humans trade, bubbles will exist. The real skill isn't predicting bubbles perfectly. Almost nobody can. The real skill is understanding your own psychology and recognizing when the crowd is thinking emotionally. Because markets don't just test intelligence, they test patience and discipline. And the investors who survive bubbles the best usually follow one simple rule. They remember that prices and value are not the same thing. In the end, the anatomy of a bubble isn't really about markets. It's about human nature. And until human psychology changes, the next bubble is always forming somewhere. Understanding markets begins with understanding the mind, because wealth isn't just built with capital, it's built with cognitive capital.